everyone, and welcome to another BFM webinar, a Ringgit and Cents webinar. This is the second one that we've done. And before we get started, there are a few things to keep in mind. We've got a poll running on Facebook, or we will have a poll running on Facebook soon. So let us know what you, to gauge your thoughts. And we want to, if you have any questions, please let us know, and we will get those questions there. Now, during the MCO, there's been a lot of talk about the impact of it and the pandemic at large on our personal finances, on our bottom lines. Each of us impacted in different ways. So today we're going to go through maybe a checklist that can help us deal with it in a more systematic manner. And to help me with that, I have online with me over Zoom, keeping the appropriate social distance here, Linnet Lee, CEO of the Financial Planning Association of Malaysia, otherwise known as FPAM, and Kevin Neo, licensed financial planner with VKA Wealth Planners. I also have Malek Ali, founder of filife, who will be co-moderating this with me. And I am Roshan, Ringgit and Cents producer and presenter, and also with the Morning Run.
Roshan, can I just interrupt just for a second? If you can if you can repeat the introductions to Linnet and Kevin. I think we just went on Facebook Live just about 10 seconds ago. So
okay,
introductions. Thank you.
Sure thing. All right, so we're also live on Facebook. And just to reintroduce the panelists today, Linnet Lee, CEO of the Financial Planning Association of Malaysia. Hi, Linnet. And we have Kevin Neo, licensed financial planner of VKA Wealth Planners. Hi, Kevin. Hope you're doing well. And
hi.
Yeah, and co-moderating this with me, Malek Ali, founder of filife and also founder of BFM Radio, which is where I'm from. I'm Roshan, producer and presenter for Ringgit and Cents. So I think let's just kick it off. So today we're looking at a checklist to maybe help us more systematically tackle the personal finance element of the MCO. So first things first, what's the top line, the first thing we need to pay attention to when we're looking at that personal finance checklist, especially in this MCO time?
Well, I would say that we need to sustain our lifestyle because we got things to pay, and then we have responsibility to fulfill. And to do all this, we need to have money. That's a given. And hence, the first thing that everyone should be mindful of and pay attention to will be your cash flow. That means how money come into your pocket and how money would leave your pocket. So cash flow management, I would say, is the first and very fundamental thing that you should look at.
And could you break down the components of cash flow? Obviously, it's income and expenses there, Kevin. Could you elaborate on that a little bit more?
So obviously, we will have income, but you can also further break down your income. We have a fixed income, or you may have a fixed income plus variable income. For example, a person who rely on a basic salary plus a sales commission. So your variable income would be something that it may be difficult for you to predict, especially during time like this, where it may plunge a lot. However, in terms of our expenditure, you will have also fixed expenditure. That will be things such as our loan commitment, your regular savings to build your life goals. And then there will also be your variable expenditure, which are things that sometimes we may not remember where the money is being spent on. So these are the four main components.
Linnet, do you have anything to add to that?
Yes, and also, during these MCO times, you really need to go back and review your cash flow in terms of your income. I want to give an example. I had a phone call from an ex-colleague. She used to do online business. She did it so well, she decided to quit the job. But recently she called me and I said, hey, you're doing online, you should not be affected by anything. But she told me, you see, I sell clothes online. My clothes comes from China. When China locked down, I have nothing to sell. So because I have nothing to sell and it's hard to send out things, I am caught. So you may have an online business, but you will still be stuck because your goods are physical goods. So on this note, then you would need to then ask yourself, where is my next dollar going to come from and how are you going to survive? And this is where we find that people who have emergency money, they find that they are a little bit more, they have breathing space rather than having to scramble for the next ringgit.
They will be less stressed in a way. So that will release their creativity to think about how they can bring money in.
Yes.
So I think the important thing when we look at cash flow is essentially whether it's a positive or negative, right? Whether your income is more than your expenses at the end of the day. Now, as you've just illustrated there with that example, Linnet, there are a lot of people who've lost their incomes or have less income right now, or even have seen salary cuts. And that goes into territory where you're seeing negative cash flow. Now, let's talk about the positive side first. Let's say you've got a positive cash flow at this point. You still have income and still more than your expenses. What should you do right now? Kevin, Linnet, who wants to take this first?
Well, if your current cash flow is positive, congratulations. It's a good thing to have. Now, you have to consider this fact. Let's say that when we do the planning, we are going to always look at what is the worst scenario or worst situation. So let's say this MCO is going to be prolonged, touch wood, then your situation today is good, but it may change to become not so good later. With that in mind, you should consider to channel your surplus in the cash flow to your savings account so that you can shore up your emergency fund.
And yes, Linnet, sorry.
Yes, and I think this is a perfect time for people to, because we have had about a month of MCO and a bit more, it's good time to review your income, your expenses. In the event that it should be prolonged, you would know then whether, based on what you have done in the last month, are you able to carry on, because you know how much more you have. So I think that's very important to sit down and do. And if you're not too sure how to do it, if you have your financial planner, please go back to your financial planner. If you don't, then you may need to speak to one and see how they can help you to restructure under such circumstances.
So we're still on.
Can I add on something?
Sure.
Even my cash flow situation today is positive. I can also take this opportunity to review how I actually spend my money, because having positive does not mean that your spending habit is okay to continue into the future. So for example, MCO, if it has taught us anything, it has taught us that actually what we need to have a good life is very simple. We don't have to spend a lot of money. Cooking at home can make everyone very happy as well.
So I actually want to touch on a few things that have been said here. In particular, I want to spend a bit of time on setting up emergency funds. I think this is a sorely understated element that we need to pay attention to. So from past conversations, I think for employed people, it's between 3 to 6 months of expenses, and for freelancers, 6 to 12 months. So could we talk about this? Because a lot of times people look at their savings account in total as emergency funds, but it's important to have a separate accounting for that, right?
Indeed, it is very important. If we pull everything together, then eventually you will realize that when you need the emergency fund, it may not be there because it may subjected to our impulse spending or spending that we can no longer remember.
And just to give you a sneak preview on what's to come in the coming sessions, we are bringing in a couple of financial planners who will give you first-hand experience of their clients who actually did a financial plan and how they fared during the MCO. Kevin has shared his, and I will also share that I actually have 6 months emergency, and when the MCO hit, I didn't feel the stress because I knew I had money to fall back on. However, if MCO lasts more than 6 months, then I have to relook, and that's why I'm going to relook at it. So if there's anything to go by, I think what we're doing will be something that listeners should also follow as well.
So just
sure, Malek.
Here
and kind of like say that we're going to put up right now on Facebook Live. We're going to put up a poll on basically how many how much reserves, how much cash reserves do you have? Do you have cash reserves of at least 3 months? I mean, 6 months is ideal, but let's just start with 3. Do you have cash reserves, 3 months cash reserves or more? Is a yes/no answer. We're going to put it up shortly on Facebook Live, and then we'll come back, and our producers will come back with the results, and we'll convey those results in this conversation. Over back to you, Roshan.
Thanks, Malek. Okay, so emergency funds can't be understated there, and actually you mentioned. Linnet, we're actually going to be talking about this next Tuesday at 12:30 p.m. Tentatively, that's what we're going to be looking at, essentially how to reconstruct your financial plan with everything that has come in play to be more adaptable in that sense. Now, 3 to 6 months is important. You've talked about going beyond 6 months there, Linnet. Now, there are other ways to beef up the cash flow, right? So even if you've got, say, sufficient to 3 to 6 months, The next question I have on my mind, or actually I've had from people, is that should I take up the things like the loan moratorium, the EPF, the iLestari programs? Should I be accumulating more cash as much as I can get? And this also applies to those who have negative cash surplus right now, negative cash flow. So Linnet, do you have any thoughts here, or Kevin?
Yeah, before we talk about what should we do with all the stimulus package that's been rolled out, I want to highlight that a credit card is not emergency money. It is a very expensive loan which you have to pay back, and if you don't have money, please don't touch your credit card. Right, Kevin?
Yes, agree.
Okay, so I will let Kevin walk through the stimulus packages, and I will also jump in as and when necessary. So go ahead, Kevin. You want to talk about the stimulus packages?
Hang on a second. Sorry, just to interject, just so that we follow things in a little bit of a logical manner. Just bear with me. Say you are experiencing negative cash flow, right?
Yes.
Your, like as your example, Linnet, the online income of this lady has gone. What do you do next first, right? And before we go into the stimulus
Yeah.
package, what can you do yourself first? Would anyone, like either of you, like to attempt this? You have negative cash flow situation right now.
Well, if
Actually,
we have...
this would actually, the negative cash flow, whether there are three scenarios we are looking at throughout this conversation. One is someone who has a negative cash flow. The other one, someone who's okay, but a bit stretched. And the next one is everyone is all okay.
Not
and
affected.
Yes, not affected. And we're going to walk through these three scenarios, and we're going to talk about their cash flows as well as and how it relates to the stimulus package would relate to that. Right, Kevin?
All right.
Yeah.
Good.
Go
Kevin,
ahead,
So
Kevin.
because the stimulus package, the main objective is to put money into the pocket of people who needs it. So if you are in a negative cash flow situation, maybe this amount of money could help. Maybe it only help you to relieve to a certain extent. So what it's more important is that we do not rely or counting on any aids or stimulus package. We have to look at your own self first. What are the financial resources that you have accumulated throughout your working life? So what I'm saying is that you should take stock of your financial situation first. Then if you know that over the next few months, your negative situation will happen, then you need to first prepare what are the asset or investment that you can put in plans to liquidate, so that when that comes in the next month, you have new money coming in to replace to cover up the gap that you have in terms of your cash flow deficit situation.
But
Correct.
Kevin, in this situation, there is a saying that basically the markets are really bad. If you have funds and things like that, they're probably likely to be not doing too well. And now it's not a good time to sell some of these investments that you have. So how do you balance this? The fact that you are on the one hand it's not a good time to sell. On the other hand, you need the money because you're in negative cash flow.
Well, apparently the investment market has not been kind to everyone as well. So most likely your investment value has taken a hit and has dropped. However, if we look at it, you need to know what is more important to you at this current juncture. So if survival becomes a huge issue to you, then having more money in the future, that means, which means holding on to your investment. If you cannot even get past this period, what goods are the money meant for you in the future? So you have to understand the priority as well.
Okay. Thank you.
Actually, on that point, so we talked a bit about the loan moratorium there, and would that be the first stop before going to divesting your investments in a period like this?
Yeah, logically, that should be the first thing that you review before you come to touching your own asset, because that takes time for you to build up anyway. And bear in mind that for most people, very likely our majority of our expenditure actually comes from our loan commitment. The first culprit will be your car loan, because most of us need to have a car. So the loan moratorium allows us to take a break for 6 months, that you can stop servicing your car loan. And because car loan, the way interest is calculated, it wouldn't add any new interest to you, even you stop or you continue to pay. So if you're really in a dire situation, this should be the number one loan that you should take a break from. It will only delay your loans for another 6 months, which shouldn't be a matter that is very important.
And to add on to Kevin, if you are dire straits and even your housing loan, you're having problem, you can take the moratorium. I strongly suggest, and I've done things like this before in the past, not in an MCO, but I was in financial difficulty. I've actually gone back to the bank and asked for a little bit more, because what they're offering you now is that there is a period where they still charge you interest, but you just don't have to pay until later, and which means your loan will stretch 6 months. I understand that there are some banks who are kind enough to say that they will just charge you the interest for the 6 months, but it's not compounding, which is good. But if you really are in dire straits, you may want to make an attempt to go to the bank and negotiate for maybe even interest-free period, because I understand that one or two Islamic banks are actually doing that for their customers. So I think at this point in time, dire times, you need dire action. So these are things that they will open, because at the end of the day, you must remember something: the banks still value you as a customer, and if they value you, they may be able to do something or other for you.
So this highlights a point that I had in a previous conversation with Nirmala Subramaniam of AKPK, that's the Agency Counseling and Pengurusan Credit, that you shouldn't not go and talk to your bank about this, because like you said, Linnet, they value you as a customer, and at the end of the day, they might want to do what's needed to help you pay back your loans. I think that's their first priority there before they look at other options. Just separating the two though, because Linnet, you talked about compounding interest there. When it comes to the hire purchase loan, I think from my understanding, it's quite a simple delay of 6 months. Well, that's not the same thing when it comes to mortgages, right?
Yeah. It is not.
Go ahead, Kevin.
So what happened, Linnet just now mentioned that some banks have announced that they will only charge interest but not compounding interest. What they actually announced, they announced it very, the announcement made was such that they will waive compounding interest. They did not say that they will only charge interest. So what happened is, I have a situation, someone actually told me, hey, my bank is very kind. I say, why? Because they won't charge me interest if I take a break. So I said, no, they only say they will waive compounding interest. Compounding interest is the interest on the interest that they are charging you. So they will still charge you interest, which is fair, because when we borrow money, we are expected to pay interest for the amount that we borrow. And even you don't take a break, you will also incur this interest payment. So how is it different from car loan is that when we borrow for hire purchase car loan, they will calculate the interest for the next few years and add it up to the total amount you borrow today. Then they divide over the tenure, and then this is the amount you will pay over the next several years. But in house loan, interest will be calculated on the outstanding amount that I still owe to the bank every month. Therefore, it will still be accumulating interest over this 6-month period.
And that's why we tell people who are okay, don't be tempted with the extra money. Please pay your housing loan. Yes. Because remember, by the same token, you are paying interest on your balance of your principal. So if you continue to pay because you can afford to, then voila, you will have actually reduced interest at the end of the day. So please pay if you can. After all, as I like to say, hutang mesti dibayar sebelum mati. So please pay, unless you're in dire straits.
But if let's say you are not very sure whether 2 months later you will still be able to keep your job, then maybe you should channel this loan payment for your house into your emergency fund so that you can be safer if that really comes to happen. So it really depends on the situation.
Yeah, and talking about emergency fund, I was just sharing with Kevin yesterday that now is not the time to be shoring up your emergency fund, because I would consider this as a part of an emergency. If you have emergency funding, this is the time you should take out your money and use to pay whatever necessary expenses that you need to pay. But I think one of the most important things you need to sit down is just relook at your income and your expenses. Whether your income is going to remain the same or is it going to reduce. Your expenses, is there any way you can cut? You'll be surprised how much leakages. I keep reading Facebook friends saying that oh, I cook this, I cook that, I save so much money. If I go to a restaurant, I will have to pay a few hundred ringgit, and now I only pay 100 over for just for the ingredients, and I cooked it myself. I have time. So I would say that post MCO, there will be a change in lifestyle, because in a way it forces us to relook at how we are. We may not be so be tempted by retail attention, grabbing attention and spending money like the way we used to. So in a way, I would say this is a silver lining to the whole cloud of MCO.
It's a blessing in disguise.
Yes, it does. It is.
And now that's it. For those who are currently cash flow negative, right? So expenses are now heavier than outweigh their income, or maybe they've got no income at this point. They're one of the few they're one of the people who have been impacted by job losses, salary cuts, which are happening as we speak. What are the first steps here? And is the loan moratorium a way to help bridge that financial gap there?
Yes, we said that if putting food on your table is an issue, the moratorium you should take, because
No question about it.
Yes, because you need to survive, and so that you can live to fight another day. You can money you can still always earn back, but health and family is very important. You need to get your priorities right.
Okay. We have the polling results coming through Facebook from our producers. They say that our last poll was at 75% for they have 3 months cash reserve. For 71% has that, which is fantastic. Thank you very much. Well done. Good job. But
Yep.
we also have 29% that says they don't have 3 months cash reserves, right? So any words of advice for, I mean, just now I heard from you, Linnet, to say that now, you know, for those of you who have that 3 months reserve, well done, good job. And now's the time to actually be able to, like, now you see the benefit of that and you can use it, allow yourself to use it if you need to. But what about those who do not have 3 months cash reserve? Any words of advice you can give them?
Do your very best to pare down your expenses. And, yep. Make sure you work hard and keep your job. and make a resolution for yourself after the MCO to please start saving.
It's also important that if you really don't have any savings already, try to be looking for help, be open to look for help, ask for help sometimes, talk to your friends, your family members. Do not try to put all this burden onto your own shoulder. You will eventually break and collapse.
Yes.
Yeah.
And one of your best friend, as Roshan has spoken to AKPK, especially when it comes to debts, there's no shame in going to AKPK for help. Their services are free. They're very efficient. I have seen them in action. They do a great job. So if you have debts, please, do not focus on the debt and worry, but rather look for solution. AKPK will be able to help you. Yeah. So that is one area. Mm-hmm.
Yeah. So sorry, Malek.
Yeah, I'm just interrupting a little bit just to say that we're going to put up another poll since we're on the discussion of loans, about taking moratoriums on loans and so on. We're going to put up another poll, and just to ask you one question: have you taken up any form of loan moratorium in either your car loan or your housing loan? Have any of you on Facebook Live taken up this moratorium? We will open up the poll shortly. And we'll come back with the answers to the results of that shortly as well. Over to you, Roshan.
Thanks, Malek. Now, before we wrap up a bit on the cash flow side, what do you think are the most important lessons to learn from not just the MCO, but the pandemic as a whole? I think we've had a lot of people maybe haven't faced something like this since 2008. And for a lot of young people, for myself, for instance, this is the first real crisis that we are facing as working adults. What are the most important lessons that need to be hammered home from this, and things that you've learned from your own experiences with previous financial crises, whether it was, or previous issues, whether it was 08 with the banking, with the financial crash in the States, or even 1997? Do you have what are the key lessons there?
For me, I would say that the key lessons actually come in a package. It's called having savings and also make sure your lifestyle is in check. Why I say that, remember just now I mentioned variable income, people who has income that sometimes can be high and low. It can be a two-edged sword. I have spoken and worked with a few clients who have earning commission income and whatnot. So what happened is, because their income will be high for a certain period of most of the years, so this helped them to build up a lifestyle that they actually cannot seriously afford it if it is only based on their basic salary alone. So you have to understand that our lifestyle, if you are not keeping it in check, eventually it will become part of your identity. And in the future, when certain things like that happen, you want to tone it down, it will be rather very difficult for you to do so. So having savings and make sure that you live within your means is very important.
And what the MCO has actually taught us, which will carry us well in future, would be that if you had a very, you have not been so disciplined in your lifestyle, but because MCO forces you to stay home and not go anywhere, no entertainment, you find that you can actually live without them. And there is a belief that if you do something for 21 days, it becomes habit forming. And if you have already formed that habit, you will know that, hey, it's not all doom and gloom. You can do it. So the lessons that I would like everyone to take away is use this duration to form good habits and keep it up. And I'm not just talking about money itself. I'm talking about skills, life skills like cooking, and as well as your health. You learn creative ways to do exercises. I remember Julian in one of his chat, he said that he learned to do yoga. I think Touch and Go, if you have your Touch and Go e-wallet, if you look inside that, they'll show you how to do exercises. You can just stream live and follow them. So there's no reason to put on weight and binge on comfort food. You can still keep your health, because when you keep your health and you are healthy, your body will be able to fight against viruses, any sort of viruses. You'll be less susceptible to it. So nothing would do well except being healthy financially as well as physically. I think this is the greatest takeaway from this MCO.
Kevin, anything to add there?
I just want to say that, you know, sometimes people believe that they have to get a gym membership for them to keep fit and exercise, but MCO has shown us that you don't have to do that. If you really want to do it, you can do it at home. Watching YouTube, you can also exercise and be fit.
Yes, and if anyone wants to take the challenge, I am doing a plank challenge. I'm up to 100 seconds of planking. Please join me and post your results and tag me in. I'm happy to if you're part of my challenge as well.
And where is this, Linnet? Is it Instagram, Twitter, Facebook? Where should people be?
It's on my Facebook under Linnet. So every time when I do my plank, I will post my target is 180. And after that, if I hit 180, I'm moving up. So it will build your core muscles. You will also build your resistance.
We won't ask you for a demo, Linnet. I'm not at this. I'd like to move the conversation along. Coming back to the personal finance checklist during MCO, I think one of the items of the checklist is your investments, right? I think you have to check on the status of your investments. And I think we touched this a little bit. Kevin, you said that if between survival and keeping your investments going, of course, go for survival, you know, and withdraw, and you know, because you need to survive, you need to put food on the table. But what if you are okay in terms of, like, you as I say, you're stretched, but you're generally okay. You don't really have to touch your investments right now. Should you change any aspect of your investment? Should you review it at this stage, or is there anything that you need to do? Now, markets are pretty much like 25% down, maybe 30% down. KLCI is, if you are invested only in the local market, that's even worse. So then what do you do next? What do you do with your investments?
Definitely an unprecedented event and time like this will prompt us to review at our investment and also how we have made our investment decision in the past. But when you review your investment, you should not review just based on the performance of your investment alone. You should be putting more focus onto what was your objective of this investment in the beginning. If your objective has not changed, then should you change your investment just because it has dropped? I don't think this is so straightforward. You need to have a more deeper conversation with yourself. If your timeline is still way to go, then actually you may be able to afford to ride through this volatility. If your situation is not in a dire strait, is not in a dire situation and it's not stretched, you may actually consider to top up to average now on your investment as well.
Yes, because just my own personal experience, I'm going into retirement soon. I've been accumulating my stocks for retirement. I'm looking at dividend yielding stocks. I'm not recommending that anyone follow me, but you should speak to your financial planner or your financial professional to help you. But this is an opportunity for me to pick up stocks dividend yielding stocks that I want to keep in my retirement portfolio. So these are for people who are okay, they don't have to worry about money. But bear in mind a few things, and I think Kevin might have said that: your investment goals, your ability to take risk, your current financial situation, and whether your investment. So we had a little debate over it, whether you should pick up the same stock or unit trust, or do you look at something else, especially when your unit price that you picked up is very, very low. So these are things that you need to look at. These are conversations which I think is very personal to holder. You should speak to your financial planner because they know your financial situation. They're in a better position because what you get from family and friends may not be suitable for you because they're different. They have different risk appetite from you. Kevin,
You know, during this period, actually, because I'm a financial planner, so evidently there are people who come to me and say, hey, now market is cheap, what should I buy? So the first advice I tell them is you must understand why are you investing in the first place. And second, don't invest just because other people are investing. Don't invest blindly. So I want to share one classic example here. You know, this software that we are using now, Zoom, right? It is listed in the US as the name is Zoom Video. Then the stock, of course, has fly quite a lot. From 27th of January, it was trading at $70 like that. And then it flew to the peak of $159. But at the same time, there is another stock. The name is called Zoom Technologies, which is totally two separate entity, no relation one. That company stock was traded at $215 on the 27th January, but flew all the way to $20.90. It has grown by 872%. This has also prompted the SEC in the United States to put a halt on the trading of this stock because investors were generally confused between Zoom Technologies and Zoom Video. You guys wanted to buy Zoom Video, but you ended up buying Zoom Technologies. So this is a very good example of invest with reasoning, not invest with your emotion.
Herd mentality.
So there are a few things there, right? One is your goal and your timeline. Those are very important parts. But also when it comes to if you are currently, your portfolio is in the red, there are two ways to go about it. One is to keep at it. The other one is to add more to it, further invest. What are some of the key criteria that I, as an investor or someone with a financial goal, needs to look at before I do any action, any of those actions? So I've got my financial goal. Let's say it is children's education, right? How do I go about addressing that with the current situation that we're in?
If you are planning for your children's education and the planning is for the child to be studying in overseas, then at this juncture, you may also need to review because most people, they tend to invest in the local market alone. So they have totally forget about the currency risk that they need to exchange in the future. So when you review your investment, you may also want to review whether or not you should diversify into asset that is denominated in the foreign currency as well. And then if let's say you cannot take, your heart cannot take that things will drop further, you may want to pare down a little bit on your equity exposure so that you can move some portion into fixed income that will provide you some stability.
Linnet, anything to add to that?
This is a little offshoot from investing for life goals. I have a bunch of friends who actually are taking opportunity to trade shares. They are taking advantage of the arbitrage difference and the fluctuation in price to make money. This is just a little bit of sharing. It is not an advice and asking people to do that, because the people who, this bunch of crazy friends of mine, they are actually seasoned traders. They have been trading for the longest time. And to them, this is an opportunity. They make money. So they're very happy to stay at home, not go to work, but to trade shares. So, well, I suppose this is an activity for them which is very profitable. That's why they do that. But please beware of scams, because whenever there's a financial crisis, you see a lot of scams. And the first one, which was publicized in the news, is the EPF scam, where people tell you, you want to withdraw your money, please click on this link, and it was a fake link. There'll be others, they'll be coming as well as things gets worse. So be very careful. Make sure you go to the reliable websites. For example, if it's anything to do with EPF, make sure you go to EPF. Anything to do with your private retirement scheme, please look at PPA or the respective providers. You know, don't just click blindly. One of the things that I also noticed is when you look at some of the Facebook friends who send you, or WhatsApp friends who send you things and ask you to click on the link. I know your friend is reliable, but please don't click, because sometimes they just forward things to you and it may not be verified. You may land yourself in hot soup. Just be very, very careful. Sorry, Roshan, I've diverted from your investment. I was just worried about people falling to scams, especially investment scams, because when interest rates are down, investments are down, people are desperate to see where they can grow the money, and they will be very attracted to the first thing that comes that shows you very good returns of income. If it's too good to be true, again and again, it is always too good to be true. Please stay clear. Be very careful. All right.
Great. So that's another thing for the checklist. Be aware of scams. Fantastic. Just now, I just want to come back a little bit to the poll results on basically what we had the poll results on. Have you either taken up loan moratorium or EPF withdrawal? We haven't spoken about EPF withdrawal, but we put up the poll. EPF withdrawal for during this MCO times, and what we have is like 37 people have said 37 people said yes. Minority said yes, 37, but a substantial minority, and about 63% said no, they haven't taken a loan moratorium yet. The results are quite consistent with people with 3 months cash reserve just now. We had 70% just now. So I think this result is quite consistent amongst the audience that the majority of you have those cash reserves, so you don't need to tap into your loan moratorium yet. But there is a minority, and also a significant minority that do, 37% is a significant minority that do have taken up the loan moratorium. And I guess, Kevin, you already expanded the reasons why you ought to. If it's survival mode, definitely. A car loan, definitely. A mortgage, if it's survival mode, yes, please do so. But if you don't need it, don't, right? So that's the general advice. Now let's talk about the other element of the poll, which we didn't discuss it very much yet, about EPF withdrawal. So you are allowed to take out, as I understand it, 500 ringgit from your account every month for the next 12 months, right? Then the second thing is that even before the MCO, we had this sort of, can you go down from 11% to 7%, right? So these are two things that have impacted from EPF. What is your advice? Let's start with Kevin first. What is your advice on on whether you should touch your EPF? And if so, which of the two options, either or both?
My point of view is that EPF is meant to be our retirement funds. For many working people, if it's not for EPF, they may not have savings for retirement to begin with. So unless you really, really have to need it, otherwise you should actually just leave it alone, because these are money for my future self. You will have more problem in the future if you actually make withdrawal from it today. But I also understand that the amount is not going to be substantial enough to really affect that my retirement fund will disappear in the future, but it will just be, it will still draw it down a little bit. And the thing is, having this kind of backup actually will allow a person to not really stretch their ability to think how they can solve a problem they have today. So if you fall back to something too easily, then you may actually miss out on opportunity, and you may actually do something that is detrimental to your own financial health in the long run. So unless you really need it, otherwise you should just leave it alone.
Linnet, do you have any other thoughts on this?
Yeah, I concur with what Kevin has said, and I think that when you whatever you want to do with your EPF, and I think this calls for another session on retirement and go deep dive into it later on. But on the on a big picture, if you don't need the money, if you're not in dire straits, don't touch. If you are in a little bit of difficulty and need a helping hand, then you may want to look at which one you want to touch. Bear in mind that EPF gives you a steady return of investment. Your PRS is going to fluctuate according to the market. So you need to decide which one you want to touch. Because on the one hand, if you take from your EPF, you know that money is there, but you'll be reducing your retirement money. If you touch your PRS, now it's a down market, your PRS may not be worth as much as you have originally invested. You may not want to touch it also. So ultimately, you need to make a decision from there. And if you're truly, truly broke, need food on the table, you need to take advantage of both. Please do so. You know, again, survival is of utmost importance.
Okay. I'd like to backtrack a little bit to, we talked about EPF, but I'd like to backtrack a little bit now to investments. We were on the topic investments just now. So there's one question from Facebook here, which is to say, Kyle Liao from Facebook is asking, is robo-advisory platform recommended for investment? And let's put a spin on this, which is it recommended for investment during this time, during this MCO time, right? So any thoughts on that, either?
I think Linnet has responded with chat message.
Yeah, doesn't matter. We can address it on for the Facebook Live participants.
Yeah.
Is robo-advisory platform recommended for investment?
Yes. Well, one must be very aware when you look at a robo-advisor. Is it from a product provider? Because if it's a product provider, chances are they will help you to track your investment, but it may be limited to only certain investment asset class. Whereas when you work with an independent financial planner, they will be able to look into all aspects of your investment asset classes, which can range from a simple thing as your unit trust investment to something more sophisticated like even antiques, collectibles like your watches, your Rolex, and your Patek
Private equity.
Yeah. So it's okay if you are just starting out with your investment and it's related to that particular investment. However, you should take 2 steps back and you should look at not only just investments, but how does this investment affect your life goals? What about protection for your investments? And when I say protection, it means either takaful of insurance. What about the tax angle from it? And at the end of the day, because now it's MCO, while we all want to be healthy and all that, but sometimes things do happen, the asset planning aspect of it as well. So you need to look at things in totality. If your robo-advisor can do that, by all means. But if your robo-advisor cannot do that, then you need to ask yourself, how then am I going to manage all this in relation to your investment? So I think that should answer your question.
Okay, there's also another one which combines the 2 topics. Now, one's topic of topic of robo-advisors, and then the other one's topic of EPF. This is Emerson Dinesh from Facebook. Is it a safe bet to withdraw from EPF and put them in robo-advisors to supersede the 5 or 6%, the 5 point something % returns per annum? Thoughts on either of you? The 5%, or you go for the take out from EPF and put into robo-advisor?
Kevin?
well, he used the word, is it a safe bet? So I will start with saying, never bet with your retirement money. All right, so to get back to the question, you see, if we withdraw from our EPF to invest into any other investment product, for example, in this case, robo-advisor, if you are investing in a very aggressive portfolio, definitely you should expect more than 5 to 6% of return over the long term. That should be quite a fair assumption. Now the question is, once the money has left our EPF account, before it left EPF account, we have very limited ways for us to touch the money. So once you have taken it out, let's say you invest into another thing, it earns 10% for 1 year. But the following year, your hands can actually touch the money. Will you be actually take out the profit and spend it, or will it actually stay invested until you retire? I think this is a question that you should actually put more thoughts into.
Yes. And also
Go on,
a
go
lot of
on.
people, sorry, a lot of people are not aware when you take money from the EPF and invest, and for some reason, if you want to put it out back again, sometimes EPF has got a cap on it, if I'm not mistaken.
60,000 a year for a voluntary contribution.
Yes. So depending on your age, because if you are still, if you're not retirement age, no problem, because when you cash out your unit trust investments, you will go straight back into EPF. And I believe if you withdraw it for approved investments by EPF, it will go back. But if you're taking it out as a withdrawal, cash withdrawal, and you're going to invest and you want to put it back, you are not going to instantly get your 6% for the total amount. You can only get 60,000, and then with the next 60,000 you put in, and another next 60,000. So you must take this into consideration first as well.
So Dinesh, one word of advice to you: if you can consider to withdraw from EPF to make investment, it should imply that your current situation is quite okay. So consider to make this investment using your cash. That will make more sense to you over the long term.
I can put a personal experience on it. I can put a personal experience on that. I moved my children's the savings account. I moved money from my children's savings account to a robo-advisor when the markets went down really badly, 25-30%. And what I did was I said, it was part of an education thing for me, for my children. I said to them, Daddy's going to move your money from your savings account that's been earning you only I'm in Singapore, so it's about 0.6% per annum. I'm going to move it to this robo-advisor advisor service. And then so I put it in, and their return so far has been 16%.
Wow.
over 1 month. So it is. I'm basically saying that yes, markets are volatile. Their horizon is 55 years. Yeah, from now. So not a problem. But I think it's not for things that are supposed to be safe. Things that's meant for your retirement. It's okay if you have, as you say, Kevin, if you have cash and you are able to do that, that's fine. But if you don't have spare cash, or you're just using the EPF money to put it into using the EPF cash to make it that, then that is a bit for a robo-advisor, that makes it a little bit more risky. Yeah.
So Malek, that highlights the volatility of the market, right? And then that's where we go back to what we talked about earlier, which is your time horizon and your financial goal. So if you're young, you're 20, 30 years old, and you're planning till you're 55, you've got a much longer runway for you to plan and invest. So even if your if your portfolio is in the red, it may not be time for a younger person to panic yet. But what kind of strategies? Now, this obviously is very simple ways to go about it, but are there strategies to start investing? Because I think it's a big hurdle for a lot of people. They haven't started investing on their own outside of EPF, and we've just talked about EPF. Do you have any, starting advice for people who are looking to invest, ways to do it in a way that isn't scary, especially in the environment that we are in today?
Over the period of last 1 month, I've spoken with a lot of people who are below 30 years old. So what happened is they are coming to us for investment advice, and their goals, according to them, is to build a passive income and to not have to worry about making money through their working job because they have investment. So these have a mismatch in terms of expectation. They seem to think that when they have investment, they do not have to work anymore. So I would suggest that they be more realistic. If you want to make investment, it's for you to set aside whatever surplus you have today so that you can pay for your goals in the future. It's not for you to stop working. And then before a person invests, this person should make sure that he or she already set aside sufficient emergency fund. Then as per how to start investing, you just have to start from a very basic thing. You can start from savings your money in FD because you don't know. If you do not have the required knowledge, don't be a hero and follow your friends to trade certain stock or follow certain hot tips. Sometimes it will burn you back one. So if you do not really know, you can diversify your risk through investing through things like unit trust fund, exchange traded funds, because by nature of diversification, it will have lowered down your risk already. And start small. You don't have to start big, but if you start small and continue regularly, eventually you will be the winner.
So that's dollar cost averaging, correct, Kevin?
In a way, yes, but I'm more referring to, because let's say today I have started investing. So then later on I have stopped because I have started, so I stopped. But I'm still making money every month. If I don't save aside my income, my portfolio will not grow. The best way to grow your investment portfolio is continuing put money into it. Our EPF is a very strong evidence. It will only grow not because of the dividend alone. It's by virtue of we are still keeping money into it every month.
Actually, it's not a case of should I take my EPF money or not. Why not keep your EPF money and use, if you have your own money, use your own money to invest. Because you see, if you are saving for a particular life goal, any life goal for that matter, children's education, and you intend to take your EPF money for children's education, or we talk about retirement also, you need to have investments in different types of asset classes, and we can talk about that in an investment session. But basically, if you need to have different asset classes, so you do not have to sacrifice one or the other. You should actually spread it. So for us, from the financial planning industry, we look at EPF as though it is a bond. So that's why we don't really recommend people to take out the EPF if they don't need to do the investment if they can. It would be better for them to use their own money to invest into equities, keep their bond, because where else would you get compounding interest and better than FD rates other than from your EPF? So why? If you have money in the FD, you should take out the money in the FD and invest instead. So this is a general rule of thumb that we would like to share with people.
I'd like to interject here and just kind of like say that now is the time. We have about another 8 minutes for the conversation. I'd like to basically address all questions. If you have any questions, now is the best time to ask questions, and we'll run through all your questions. So I think we're going through some of the Facebook questions. If that's okay with all of you, I'll just go address some of them. I've tried to get through as much as possible. Someone talked about currency. Hang on, let me just, I've lost the individual's name, but someone currency. How should they just, if they were to invest, should they just remain in, if they wanted to go for US dollar currency or another other than Ringgit, is that a good thing to do or not? Is that something that it's worth doing? Linnet?
Pandemic is global.
Yeah,
and whichever
yeah, but some currencies are stronger than others, right? In this sort of pandemic. I mean, we see the Ringgit, for example, depreciating. There's an oil crisis going on. Ringgit today has got hit really badly with that. So should currency be a relevant factor at all at this moment in time?
But it could go both ways, right, Malek?
Yeah.
So I think So I think one of the question also is asking is, what are the ways to do so, right? So we were talking about diversification. So having all our eggs in the Ringgit basket also may not be the most ideal thing. So how do we go about addressing that concern? How do we diversify not just over asset classes, but also in currency, geographical as well? Yeah. So how do we get a bit of US dollar exposure and not buying dollars themselves, but asset classes denominated in the US dollar, in the Sing dollar? What are some advisable ways to go about that?
Well, there are fixed income funds that invest into the bond market in the US as well as stocks in the US. So these means that you can gain exposure into the other kind of currency by virtue of buying the asset that's denominated in those currency.
And ETFs as well? like the one that we have, Stashaway, which is approved by SC. That one is in US. Currency, when people talk about investing in currency, I think it's more like currency trading. And if I remember correctly, currency trading at the moment is not yet legalized in Malaysia by the regulators. So buyers, beware. You want to go into that, you have to take a risk. And if this is money that you can risk, by all means. But I think the question asked was how to do it. Well, there are trading platforms, but those trading platforms are not in Malaysia. So you must bear in mind that if you go through trading platforms outside of the country, if anything should go wrong, you must be willing to pay money to go overseas to get to seek legal redress.
Because
yeah, and the local regulators are unable to help you. I think this is something that a lot of people sometimes they may not be aware. You need to know that. So if you want to go that way, by all means, but please be prepared to for the worst scenario. But we wish for you that things turn out well so that you don't have to go into that area.
But for the person who asked this question, I would first suggest that he or she should first understand why is there a need to do that? Why does he want to do that in the first place? Because whatever we make decision with regards to the investment, it should be in line with our objective and goals.
And I think there's one area we need to touch on also, and that's protection.
Yeah.
Malek, do we have time to very quickly?
Sure.
Just the one.
Yes, we do, because we also have a question from a lady called Wendy Chin from Facebook. During these difficult times, should we buy insurance? I guess we're talking about protection. And I promise you, we did not
plan this.
But protection is important, right? So let's go talk about protection. Linnet, over to you.
Okay. So the short answer to Wei Jing is short answer to Wendy. Yes. Insurance is something you can buy anytime, because you want, as long as you are healthy and you don't have pre-existing condition, it's easier for you to pick it up. When you have pre-existing conditions, then you are dependent on the insurance company or the takaful company. But I think the message that Kevin and I want to send out to you all is that it is very common that we see a lot of people when it's tough times, they tend to think that when they need money, they cut their insurance or their takaful contribution. Our message to you is please don't do anything like this, because it is tough time. That's when you actually need that extra protection, because should anything goes and the other way in terms of critical illness or accident or a death, this money is going to become useful. And there are a lot of avenues that you can use for you to be able to continue your protection plan without having to take out too much money. Can I ask Kevin to please help to elaborate what are the ways that can be done?
Sure. So during this MCO, there's also a premium or contribution moratorium for 3 months for individuals who are affected. So if you are under this group of people, you can actually apply with your insurance company or takaful operator to take a break from paying premium. The catch is you have to pay it back later. All right. Then if you still need the protection benefit, but your cash flow does not allow you to service the premium or contribution, you can actually consider review your policy or takaful certificate to find out whether you have cash value inside the account. If you have, you can actually use it to sustain the coverage period. And then for a certain type of protection product, for example, a traditional whole life product, if you cannot service the premium, you can also let it take on an automatic premium loan, which will come with you at the cost of paying interest. But the more important thing, it allows you to keep your protection benefit. And the question from Wendy is, should we buy insurance? I'll say that if you currently do not have adequate coverage and you have dependent, for example, young children depending on you, then you should consider to add on to your life coverage. You can also add on to your life coverage by paying minimum premium by getting terms product. For example, check out filife.
Yes.
Thank you for the plug, Kevin.
And
Thank you for the plug.
and we also want to say that for those who are in dire straits and you find that you really cannot afford and you really need the money that you pay for premium, another thing you could do is that instead of giving up your policy, surrendering it for money, you'll remember protection is also very important, and you may not be able to buy another protection plan for yourself. Or what you could do is actually go back to the insurance company and convert it into a paid up policy. So what happens when they do a paid up policy would be they will reduce your sum assured, they may throw away all your riders, and then they are based on the whatever cash value that you have in your insurance or your takaful, they will say, okay, it will last you X amount of duration, years, and for that, this is the amount of coverage you can get. So this is a worst case scenario, but to us is at least you have some form of coverage should anything happen. So this is one idea you may want to take home rather than to just surrender policy for money, because the money that you get back is really cannot beat what the coverage can give you. And yes, I think term life, if you find money is, you have limited cash flow, term life is actually one that you should actually pick up. Anything to add on, Kevin?
And you can pick it up without having to leave your house today.
Yes, go online. This is what we do today.
Fantastic. Thank you very much for that. I'm mindful that the time now is 4:01. We're 1 minute behind schedule. Thank you. We would like to appreciate to extend our thanks to everyone on the who came in with questions. And I think we have. We just want to highlight a couple of things. One is that if you were to send contact feedback at bfm.my and pass us your email address, we'll give you a little bit of a summary, a synopsis of basically the checklist for the MCO. Again, the address to send your request is feedback@bfm.my. I might ask one of our technical producers to put it up on our Facebook page to say the following, which is to say, if you want a copy, if you want just a simple checklist of the what you need to do during the MCO financial checklist, they'll put a link, the email link up there over there. Thank you very much for that. We also, I think this is a good time also just to kind of like say to say thank you to Linnet Lee and Kevin Yeo, of these financial planners who have, actually Linnet is the CEO of AFPAM, which is a Financial Professional Association of Malaysia. This is part of a webinar series that we are doing every week. Roshan, you have details on the next one. When's the next webinar on this particular Ringgit and Cent series? And then we'll talk about a couple of other things.
Sure. All right. So next Tuesday, 12:30 p.m., we're going to be talking about how to construct a financial plan that can weather any crisis. So that's next Tuesday at 12:30 p.m. And right now we've got the names. We've got Samantha Yeo of Wealth Vantage Advisory and Gunasilan Kadan of Blueprint Planning. These are both financial advisors who will be joining us for that conversation. Yeah, so next Tuesday.
And there was a question also by Chris Bay. I'm not going to answer it right now. There's a question from Chris Bay on Facebook about how do you do financial planning, or I guess what should SME owners do? And with that, actually, the best thing to do is actually tune in tomorrow at 12:30 because we will have Frida Liu. Roshan, you have details of that as well.
Yes, so Frida will be speaking to Jeevan Sahadevan, who is part of Leverage Lab, about things that you can do in today's challenging environment, business environment specifically. So we'll be talking with his clients on that. They'll be discussing everything from cash flow, leadership, marketing tactics as well, and pivot, whether it's time to what pivoting strategies you can use, and getting insights on what you can do till the MCO ends. So that's at 12:30 tomorrow, with 12:30 p.m. tomorrow with Frida Liu.
Fantastic. And with that, we'd like to just thank everyone who's come onto Facebook Live, as well as to the Zoom meeting that we had as well. Thank you, Linnet. Thank you, Kevin. Look forward to seeing you guys tomorrow at 12:30. Take care. Bye-bye.
Thank you.
Thank you.
Bye.
Thank you for us. Bye.